Jeff Brown is pitching a bunch of stocks, and one of which he's calling the next Nvidia. I reveal these stocks here for free so you don't have to buy his newsletter. No paid or proprietary info is given away here, and it's all guesswork based on clues in Jeff's publicly available sales presentation. There are many stocks to uncover, so we're just going to jump right into revealing them. All of these stocks are related to data centers, either companies that make chips and other components for data centers, or companies that will power them. Here's the clues for the first stock. I found two companies who are absolutely critical to Nvidia's operations. And I believe these stocks, like Nvidia, are worth owning for the next 2 decades, possibly beyond. These two stocks are going to play a major role in the AI data center build-out, working right alongside Nvidia on its Blackwell chip. Jeff continues and says, one of these companies has found a cutting-edge way to help push the limits of physics for Nvidia's future chips. This would speed up design and production of the chips, meaning Silicon Valley billionaires like Elon Musk won't have to beg anymore. With back orders beyond 12 months, this could not only help juice Nvidia's revenue, but Nvidia partner stock number one could go through the roof as well. This is either TSMC and Synopsys. I've covered TSMC a million times before, so I'm going to go with Synopsys. Synopsys is a leading software company that provides electronic design automation tools and semiconductor IP used for designing and verifying advanced chips and systems. Here's the top 5 things to know about Synopsys. As of July 2025, Synopsys shares trade at $585, up 16% year-to-date and outperforming the broader market. The stock has shown strong momentum thanks to growth in AI and semiconductors, but also experienced some volatility due to regulatory concerns, particularly US-China export restrictions, which reduced China's share of quarterly revenue from 16% to 10%. The $35 billion Ansys acquisition was successfully completed in July 2025, further boosting Synopsys' industry position. The average 12-month price target for Synopsys stands at around $610 to $620, implying a 5 to 6% upside. High-end targets suggest potential 17% upside from current levels. While some recent downward revisions have occurred due to increased risks related to China exposure, the overall analyst outlook remains positive. Synopsys generated $6.07 billion in revenue over the trailing 12 months, with Q2 2025 revenue at $1.60 billion, up 10% year over year, and matching forecasts for the next quarter. The company has maintained a 3 to 5 year compound annual growth rate of 11 to 20%. Profitability remains strong, with net income of $2.11 billion and an EPS of 13.51 over the past year. Next quarter EPS is estimated at 3.39, and profit margins are healthy at 35%. Synopsys trades at around 41 times earnings, delivers a 16% return on equity, and has achieved 15 to 22% annual EPS growth. Notably, China's share of revenue has dropped to 10%. Synopsys continues to lead the electronic design automation EDA tools market, holding the top spot ahead of Cadence and Siemens EDA. The recent $35 billion acquisition of Ansys expands its addressable market, adding advanced simulation capabilities and increasing its total addressable market to roughly $31 billion. Key growth drivers include rising demand for AI chips, growth in automotive semiconductors, and the expansion of cloud infrastructure, with the company targeting $400 million in cost synergies from the Ansys acquisition by 2027 to 2029. However, Synopsys faces risks related to integrating Ansys and ongoing challenges from China export controls. Synopsys is well positioned for ongoing growth, benefiting from consistent double-digit gains in revenue and earnings, strong profitability with 35% margins, and a leading role in an expanding industry. The Ansys acquisition not only enhances its technological capabilities, but also creates new cross-selling opportunities. However, investors should monitor the company's exposure to China regulatory risks, the challenges of integrating a $35 billion acquisition, and the stock's premium valuation around 41 times earnings. Ultimately, future performance depends on effective execution with Ansys and managing regulatory headwinds, but analyst consensus still points to moderate upside from here. Synopsys is a borderline buy in my opinion. It's expensive and growth is just average. However, the company is one of only 2 firms that do what it does and is absolutely essential for chip manufacturing, much like TSMC and ASML. So if chip demand surges, this company will benefit. Here's the clues for the second stock. The second partner stock isn't technically under contract with Nvidia, but their components match up perfectly. And in fact, this company and Nvidia's GPUs are partnered together in 9 of the world's top 30 supercomputers, something most tech experts don't realize. This is likely Intel. Intel is a leading American semiconductor company best known for designing and manufacturing microprocessors and other key components that power computers, data centers, and a wide range of digital devices. Here's what to know about this stock. As of July 21, 2025, Intel's stock is trading at $23.29 per share, giving the company a market capitalization of $100 billion. The forward price to earnings ratio stands at 79.92, reflecting high investor expectations relative to earnings, while the company's beta of 1.15 suggests slightly higher volatility compared to the overall market. In 2025, Intel's stock has experienced significant volatility, trading within a 52-week range of $17.66 to $33.41, with an average price around $21.96. The stock saw a 10% rally in June, driven by optimism surrounding the appointment of a new CEO, and another 7% gain following a major layoff announcement in Oregon. The primary catalysts behind these movements have been the company's aggressive cost-cutting initiatives, ongoing leadership transition, and the anticipated financial support from the U.S. CHIPS Act. Analyst sentiment on Intel remains cautious, with price targets reflecting a range of perspectives on the company's outlook. The current high price target stands at $28.30, while the average target is $22.20 and the low is $14. Notable firms have issued the following price targets: UBS at $25, Morgan Stanley at $23, Wells Fargo at $22, and Cantor Fitzgerald at $20. These targets suggest modest upside potential but highlight uncertainty around Intel's future performance. Intel's recent financial performance has been challenged by declining revenues and widening losses. In the fourth quarter of 2024, the company reported revenue of $14.3 billion, down 7% year over year, with a net loss of $126 million and a gross margin of 32.9%. The first quarter of 2025 saw revenue hold steady at $12.7 billion, but the net loss deepened to $821 million, accompanied by a gross margin drop to 39.2%. Looking ahead to the second quarter of 2025, Intel projects revenue between $11.2 and $12.4 billion, with annualized operating expenses around $17 billion. To address these pressures, the company is planning further cost reductions in 2026 and has already reduced its capital expenditures to $18 billion in 2025, with net capex expected to be in the $8 to $11 billion range. Intel faces significant strategic challenges in today's semiconductor landscape, having fallen out of the top 10 global semiconductor companies and implementing workforce reductions of around 20%, which included over 5,000 job cuts in the US. The company continues to struggle with manufacturing delays on its 10nm and 7nm nodes, while rivals like AMD are steadily gaining share in CPUs, and NVIDIA remains dominant in GPU and AI markets, putting additional pressure on Intel's Gaudi 2 chips. In the foundry space, TSMC and Samsung continue to lead in advanced process technology. In response, Intel is pushing growth initiatives such as launching its Panther Lake CPUs on the 18A process by late 2025, expanding Intel Foundry Services to serve external customers, and focusing on edge AI and on-device processing. The company is also set to benefit from federal incentives through the U.S. CHIPS Act, which supports domestic manufacturing, as industry consolidation and ongoing M&A activity continue to reshape the competitive environment. Meanwhile, competition around AI acceleration, advanced chips, and foundry services remains fierce. Intel's investment outlook reflects a balanced assessment of both risks and opportunities. On the downside, the company continues to report net losses and faces pressure on margins, along with persistent manufacturing delays and challenges related to transitioning to advanced process nodes. Execution risk under the new leadership team and ongoing global trade tensions also present uncertainties, particularly regarding supply chain stability. On the upside, Intel is aggressively restructuring costs, which could lead to margin improvements, and is set to benefit from upcoming product launches like Panther Lake CPU's Gaudi 2 and the move to the 18A node. Support from the U.S. CHIPS Act and a potential recovery in the PC and enterprise markets also offer reasons for optimism. Overall, analyst consensus remains cautious, with average price targets in the 22 to 23 range, indicating only modest upside from current levels. The investment case largely depends on Intel's ability to execute its technological roadmap and realize the benefits of cost-cutting initiatives over the next 12 to 18 months. I just personally don't think Intel is worth investing in right now, and would wait to see how its current moves work out before jumping in. Here's what Brown says about the third stock. Is this the next NVIDIA? Besides just NVIDIA's chips, there's more to a data center. And one of the biggest places for growth in the stock market revolves around memory. I'm talking about the massive amounts of memory needed in AI factories to support all the massive computations. Because the speed of chips has increased so quickly, it's forced memory processing performance to increase as well. The problem is, very few companies can achieve high bandwidth memory, or HBM, which is a necessity for AI factories. But there is one company who is perfecting it, and right now they can sell as many HBMs as they can produce. This is Micron, ticker MU. Micron Technology is a leading American semiconductor company specializing in the production of memory and storage solutions, including DRAM and NAND flash, for a wide range of industries such as data centers, mobile devices, and automotive applications. Here's what to know about this stock. Micron Technology stands out as a leading player in AI memory, drawing attention from investors due to its strong market position and promising future prospects. As of late July 2025, Micron's stock price is trading around $115, reflecting a year-to-date gain of 36% to 42%. The stock's momentum is further highlighted by robust trading activity, with daily volumes averaging 30 million shares, well above the 50-day average of 21 million. Together, these factors underscore Micron's growing appeal among investors and its relevance in the rapidly evolving AI landscape. Analyst sentiment toward Micron remains strongly positive, with most forecasting double-digit upside from current levels. The consensus 12-month price target averages around $155, representing a clear premium over the current share price. Price targets range from a low of $130 to a high of $200, highlighting a broadly optimistic outlook among Wall Street analysts for Micron's continued growth and performance. Micron's financial performance in Q3 2025 was robust, with revenue reaching $9.3 billion, a 37% year-over-year increase. The company reported GAAP earnings per share of $1.68 and non-GAAP EPS of $1.91, supported by strong operating cash flow of $4.601 billion. Looking ahead, Micron's Q4 2025 guidance projects further sequential growth, with expected revenue around $10.7 billion, EPS near 2.50, and gross margin anticipated to climb to approximately 42%. Notably, high bandwidth memory revenue is set to rise more than 50% sequentially, driven by accelerating demand for AI and data center solutions, which remain key growth drivers for the company. Micron continues to strengthen its competitive position in the memory industry, particularly through its leadership in high bandwidth memory, HBM4, for AI applications, where it supplies critical chips for NVIDIA's next-generation platforms. The company is aggressively expanding its U.S. manufacturing capacity, with over $200 billion in long-term investment plans, supported by funding from the CHIPS Act. Despite ongoing competition from industry giants like Samsung and SK Hynix, Micron is projected to capture around 20% of the global DRAM market by the end of 2025, solidifying its standing as a key player in the sector. Micron's investment outlook is shaped by both compelling growth drivers and notable risks. On the positive side, the company is benefiting from strong AI-driven demand, with its leadership in high-bandwidth memory contributing to market share gains, robust earnings, and healthy cash flow. Analyst price targets indicate as much as 35% upside from current levels. However, memory chip prices have historically been volatile, and Micron faces ongoing competitive pressure from major Asian manufacturers. Additionally, the stock's valuation has climbed following its recent rally, raising the risk of a potential cyclical downturn in the memory market. Overall, Micron is well positioned to capitalize on the AI memory boom, with a neutral to bullish outlook. Its current valuation seems reasonable if growth persists, though investors should remain mindful of the industry's cyclical nature. So I personally think Micron is a buy. It has good growth prospects, extremely profitable, well-positioned in a growing market, has awesome products, and isn't overvalued. Brown is also pitching 3 natural gas stocks that will power AI data centers, and I figured out 2 of them. Here's the clues for the first of the 2. Natural gas stock number 2 is one of the most crucial pipeline infrastructure companies in America, and they're one of the only pipeline companies with an explicit deal to serve data centers. In fact, they just signed a 10-year agreement with one of the top data center operators to supply gas to a bevy of data centers getting built in Texas. This is one of the first deals of its kind and puts this pipeline company at the top of the list when it comes to the AI energy boom. This is Energy Transfer, ticker ET. Energy Transfer is a major U.S. energy infrastructure company that owns and operates a vast network of pipelines and terminals for transporting and storing natural gas, crude oil, and refined products. Here's what to know about this stock. Energy Transfer has faced a challenging 2025 so far, with shares declining 11% year-to-date from around $20 to $17.30, and currently trading about 18% below their peak 52-week high of $21.45. Despite this downward trend, the stock's technical indicators have started to show signs of stabilization, as reflected by the RS rating improving from the high 60s to the low 70s. In July, Energy Transfer's price action has been notably constrained, trading within a narrow range of $17.40 to $17.60 and briefly dipping to a mid-month low of $17.44. This tight trading band suggests continued market hesitation, even as the technical picture begins to strengthen. Analyst sentiment toward Energy Transfer remains highly bullish, with all 7 major analysts currently issuing buy ratings and no hold or sell recommendations. The consensus 12-month price target averages between $22.60 and $23, implying roughly 30% upside from current levels. Price targets range from a conservative low of $21 to a bullish high of $25 to $26, reflecting broad-based confidence in Energy Transfer's future performance and strong expectations for a rebound. Energy Transfer's financial performance remains solid in 2025, with Q1 adjusted EBITDA rising 6% year-over-year to $4.1 billion and net income reaching $1.32 billion, up from $1.24 billion in the same quarter last year. The company maintained its quarterly distribution at $0.3275 per unit. Looking ahead, Energy Transfer's full year 2025 guidance calls for EBITDA in the range of $16.1 to $16.5 billion, representing about 5% growth over 2024 and projected revenue growth of approximately 14% year-over-year. The annualized distribution is expected to total $1.31 per unit, underscoring the company's ongoing commitment to shareholder returns. Energy Transfer holds a strong competitive position as one of the largest midstream operators in the United States, supported by a broad network of assets spanning oil, natural gas, NGL, and LNG infrastructure. While it ranks just behind industry leaders such as Hess Midstream and MPLX, the company benefits from favorable tailwinds, including robust U.S. oil and gas demand and supportive energy policies that create a positive business environment. However, Energy Transfer also faces key risk factors, including exposure to commodity price volatility, ongoing regulatory uncertainty, and legal challenges, most notably a recent $666 million jury award. Energy Transfer offers an attractive income profile, with a current yield exceeding 7% and strong distribution coverage supported by stable balance sheet fundamentals. Analyst consensus remains bullish, projecting roughly 30% upside from current levels based on target prices. However, the company's future performance will depend on key factors such as commodity price trends, regulatory decisions, and the successful execution of its expansion plans. While sentiment is positive, the stock continues to trade more than 15% below its recent highs, highlighting persistent market caution and macroeconomic uncertainty that investors should keep in mind. And here's what Brown says about the last stock. Natural gas stock number 3 is a leading producer of natural gas turbines. They can build them in a matter of months, and they're going to be key to providing immediate energy to data centers across the country. In fact, they just partnered with Chevron to build natural gas power plants specifically for data centers. This is GE Vernova, ticker GEV. GE Vernova is the energy technology company spun off from General Electric in April 2024, specializing in power generation, wind, electrification, and energy services. With its mission to electrify and decarbonize the world, its technologies help generate about 25% of the world's electricity. Here's what to know about this stock. GE Vernova has shown impressive momentum in 2025, with shares currently trading in the 570 to 580 range, after climbing from a 52-week low of around 150. The stock has delivered an 18% gain over the past month and surged 42% in the last 6 months, reflecting robust investor confidence and strong performance. Notably, GE Vernova also exhibits significant price movement, with a wide average trading range ATR that highlights its volatility and active trading environment. Analyst sentiment on GE Vernova is notably bullish, with a strong buy consensus reflected in 22 buy ratings, 8 holds, and only 1 sell among covering analysts. Despite the overwhelmingly positive outlook, the median price target stands at $474, which is roughly 17% below the current trading range, suggesting shares may be running ahead of near-term expectations. However, major banks like Bank of America, JP Morgan, and UBS have recently raised their targets to the 614 to 620 range, indicating growing confidence in GE Vernova's potential for continued upside. GE Vernova's financial performance in 2025 has exceeded expectations, with first quarter earnings per share coming in at $0.91 compared to the anticipated $0.37 and revenue rising 10.6% year over year. Looking ahead, the company projects Q2 revenue of $8.79 billion, representing a 7.1% increase from the prior year, and expects EPS to reach $1.64, up an impressive 131% year over year. GE Vernova has also rewarded shareholders with a $6 billion buyback program, retiring 6.7% of outstanding shares, and a 0.25 quarterly dividend, though the yield remains modest at 0.17%. From a valuation perspective, the stock trades at a trailing PE of 82x, with forward PE estimates ranging from 58x to 83x and a PEG ratio of 4.3x, reflecting a premium pricing that anticipates sustained growth. GE Vernova holds a dominant competitive position, especially in gas turbines and grid infrastructure, while its advanced digital asset management further strengthens its market leadership. The company is well placed to benefit from several major growth catalysts, including surging electricity demand from AI and data centers, ongoing expansion in renewables, and emerging opportunities in hydrogen and small modular nuclear reactors. However, GE Vernova's premium valuation limits near-term upside and leaves little margin for error as any underperformance, particularly in areas like offshore wind, or increased regulatory and cost pressures could weigh on the stock. The explosive demand for AI infrastructure is fueling unprecedented need for power solutions and grid upgrades, positioning GE Vernova as a critical player in the transformation of the energy landscape. Still, current pricing assumes flawless execution, heightening the importance of strong results in upcoming quarters. From an investment perspective, GE Vernova offers a compelling mix of strengths and risks. On the bullish side, the company boasts a massive order backlog and strong momentum in both grid and power solutions, with AI and data center demand fueling sustained growth. Margins are improving, shareholder returns are substantial, and the stock has benefited from strong price momentum alongside bullish analyst upgrades. However, the bear case centers on a valuation that prices in perfection. GE Vernova's PE ratio and current share price are well above typical analyst targets, and the PEG ratio of 4.3x raises concerns that growth may be overvalued. Volatility risk remains high if upcoming earnings disappoint. Ultimately, while GE Vernova is well positioned as a leader in energy infrastructure for the AI era, its elevated valuation suggests caution. The stock may be best suited for existing holders or investors willing to wait for a pullback or clear earnings catalyst. Vernova is a great company, but I would wait for a dip before jumping in. It's way overvalued at the moment. And make sure to click the link in the description to get $50 off Alpha Picks. I reviewed over 100 stock picking services, and this one is by far the best. And they don't do any scummy marketing tactics every other company engages in. So if you want to put yourself in the best position to make money with stocks, click the link in the description now.